Okay, hands up those of you who think you're paying way too much tax and you're just sick and tired of seeing a huge chunk of your monthly wage just disappear to the HMRC. So what if I told you there was a simple but a legal way to not only reduce your tax burden, but also to reduce your retirement savings all at the same time? So in this video, I'm going to show you how to use your pension contributions smartly and wisely to not only slash your tax bill, but also to reclaim perhaps some of your personal allowance and even to avoid paying back some of your child benefits. So whether you're employed, self-employed, a basic rate taxpayer, or even a high earner, do yourself a favour and don't leave any money on the table for the taxman that is absolutely necessary. So welcome back to the Personal Finance crew. And if this is your first time, a very warm welcome to the Economies channel, where together we're going to be learning the language of money and wealth. But we're also dedicated and focused on mastering money and making financial wisdom available to absolutely everybody. Hi, my name is Simon and I'm a chartered financial planner, normally based in the UK, but I'm recording this video just for you in the absolutely gorgeous and stunning island of Ibiza. So come with me back to the studio and we're going to try and get you back onto the path to paying less taxes, and I'll see you in a minute. Fed up of paying way too much tax, evading tax, and that is illegal, and it makes very grim reading. But you're also reducing the amount of tax you have to pay each year. Now that is a definition of a true stealth tax. So one of the comments I receive most from my clients is that they are absolutely fed up of paying way too much tax. So in today's video, I'm going to be focusing on avoiding paying too much tax, which is of course legal, as opposed to evading tax, and that is illegal. So what I'm going to do to put some context is I'm going to add about 15 recent articles from various sources on the screen to reinforce and to underline where we all find ourselves at the moment, and it makes very grim reading. So we're all facing a record high cost of living crisis. There are potential tax rises in the budget, meaning we're going to be facing the highest taxation since 1948. There's also a UK-wide lack of savings for emergencies, with the average savings being around £5,000, but a third of families have got less than £1,000 saved. So as you would have seen from previous videos, people just aren't saving enough for their retirement, with a projected 18 million people not being on track for even a moderate standard of living in retirement. Now, personal debt is also spiralling out of control, with the average debt of being around £4,000 per person. But debt defaults are also increasing, with about 25% of loan providers citing higher than normal defaults. And that's in addition to the £19 billion which we currently have in mortgage arrears. So now more than ever, it's important to ensure that we're making some very smart moves to pay less tax, but also to provide for our financial futures. Now, when it comes to personal finance as well as financial planning, one of the most powerful tools available to us to reduce our taxes whilst building long-term wealth at the same time is by using our pension. Now, this in financial planning is a rare win-win strategy. So by contributing into your pension, you're not only setting yourself up for a more secure retirement, but you're also reducing the amount of tax you have to pay each year. But many people are unaware of just how effective this method can be, or about the full range of benefits that it offers. Now, this video is going to explore how you can pay less tax using your pension contributions by focusing on how they reduce your taxable income as well as your national insurance. It's going to be able to help you regain some or all of your personal allowance, pay lower taxes on your dividends, and even avoid the dreaded high income child benefit tax charge. But before we get into it, I'm going to pop up the usual disclaimer to say that this video is for education and entertainment purposes only and should be misconstrued or misunderstood as offering financial advice. Okay, so let's go back to the basics. Now, in the UK, we have what's called a progressive tax system, and that's based on a combination of our personal allowance and income tax thresholds, or what we call brackets. Now these thresholds have been frozen until April 2028. So as more people get pay rises, more people are going to fall into the higher tax bracket and more people are going to pay more tax more often. Now that is a definition of a true stealth tax. Now we can all earn up to £12,570 each from various income sources, such as our salary, a company pension, a state pension maybe, dividends, interest on our savings, or rental income. All of that without paying any income tax. But basic rate income tax starts when we earn from 12,570 up to the next threshold, which is 50,270. And on that amount of money, we'll pay 20% income tax. Now, higher rate income tax starts from £50,271, and that goes all the way up to £125,140. And on that amount of money, we're going to be paying 40% income tax. Now, additional rate income tax starts from above £125,141, and that's where you're going to pay 45%. But I'm not going to focus on that level because 90% of the people who watch this channel are either basic rate taxpayers or high rate taxpayers. Now, I do get this question and this query from a lot of clients, and it's very important to understand that if you do get a pay rise and you do become a high rate taxpayer, you're not going to be paying 40% on all your earnings. You're only going to be paying 40% on the amount of money which is above or inside that threshold. Now, it's worthwhile mentioning at this point that there is a quirk to the tax system. So if someone's earning over £100,000 a year, then their personal allowance is then going to be reduced by £1 for every £2 that they're over the £100,000 limit. So what that means is not only have you lost your personal allowance in full, you're also going to be paying 40% income tax on your income too. So that means for that amount of money over 100,000, you're going to be paying close to 60% income tax, and that is absolute madness. So pension contributions offer a double benefit. Not only do they grow tax-free inside your pension for your future retirement, but they also provide immediate tax relief by lowering your taxable income. Now, this tax relief applies whether you're a basic rate taxpayer or even a higher rate taxpayer, making it one of the most efficient tax saving tools available in our arsenal. Now, every time you contribute into your pension, effectively you are lowering your net relevant earnings. Now, this is important because this impacts how much tax you've got to pay to the HMRC. So whether you're paying into a workplace pension or even a private pension, the tax relief is essentially a reduction in the tax that you would otherwise need to pay on your earnings. So effectively what that means is the more you contribute into your pension, the lower your taxable income is going to be. So let me give you an example just to underscore that for you. Let's say you earn £55,000 a year. If you contribute £5,000 into your pension, your net relevant earnings will then reduce to £50,000, meaning you're going to be paying income tax on £50,000 instead of £55,000. This means that instead of you being a higher rate taxpayer, thanks to your pension contribution, you're now going to be a basic rate taxpayer. Now, clearly, this is going to reduce the amount of tax you need to pay in the current tax year. Now, can you start to see how this might work in your favour? Now, the beauty of this is that the pension contributions can bring down your income below those key tax thresholds, allowing you to save even more. Now, this is particularly beneficial for those in higher income brackets, including about 400,000 people who are affected by the high income child benefit tax charge. What that means is if you or your partner earn over £60,000 and you're receiving child benefit, you may be subject to the high income child benefit tax charge. What that means is for every £100 you earn above £60,000, you're going to be required to pay back part of the child benefit that you receive. So once your income exceeds £80,000, then the entire child benefit is then effectively clawed back completely. But by contributing into your pension, you can reduce your adjusted net income below the £60,000 threshold, allowing you to avoid the tax charge entirely, or at least limit its impact. So for example, if you earned £65,000 a year and you do receive child benefit, you would typically have to repay part of that to the HMRC. But by contributing £5,000 into your pension, your income is then going to be reduced to £60,000, meaning you can avoid the charge altogether and you get to keep your full child benefit. Now, for families with multiple children, this can result in substantial tax savings. Now, another effective way to reduce your taxable income whilst increasing your pension contributions is through a salary sacrifice scheme. In a salary sacrifice arrangement, you agree to exchange part of your salary for an additional pension contribution made by your employer. Now, this reduces your gross income, meaning you pay less tax, less national insurance, whilst your employee's contribution directly boosts your pension savings, and sometimes you can benefit from their national insurance savings as well. Now, if you haven't made full use of your pension contribution allowances in the previous years, you can use something called carry forward, and you can carry forward your unused allowances for the previous 3 tax years. Now, this allows you to make larger contributions in a single tax year and still claim full tax relief on them. So for example, the current annual allowance this year is £60,000. Last year it was also £60,000. The year before it was £40,000, and the year before that it was also £40,000. So what that means is that's a total of £200,000 gross of potential pension contributions that could be made into your pension. If you are looking to use carry forward for the previous 3 years, you're going to need to make sure you've had a pension in place for that time. But what about those of us who receive dividends either from investments or even as part of a salary package as a company director or as part of a retirement portfolio? Well, we all get a miserly £500 dividend allowance each year, and then a basic rate taxpayer will pay 8.75% on their dividends, and a higher rate taxpayer will pay 33.75% on their dividends. Now, that is a huge difference. So what that means is if you did make a pension contribution to keep you as a basic rate taxpayer, you would also pay lower taxes on your dividends as well. So if you're a company director, a pension contribution is deemed an allowable business expense. So this both lowers your profit, your corporation tax, as well as meaning that you need to pay lower taxes on your dividends too. So in conclusion, pension contributions are one of the most tax efficient ways to reduce your tax burden whilst building a comfortable future for your retirement. So whether you're looking to reduce your income tax, national insurance, avoid tax penalties, or simply build a larger pension pot, the time to take action is now. Now remember, the earlier you start contributing into your pension, the more you're going to save both in taxes but also for your retirement. I've also recommended a further 2 videos in this series about making sure that your workplace pension is working for you by knowing which pitfalls to avoid. And I've also got another video explaining how you can get a 31% boost to your pension contributions. So thank you so much for watching to the very end, and as always for your time and for your patience, and I'll see you all again next week.